In 1923, a loaf of bread in Germany cost 200 billion marks. Workers were paid twice a day because by lunchtime, their morning wages were already worthless. Children stacked banknotes like building blocks because paper money had become cheaper than actual toys. People burned stacks of cash to heat their homes because firewood cost more than the currency meant to buy it. This is what happens when a government destroys its own money. To understand how a nation's currency could collapse this completely, you have to go back to the end of the First World War. Germany lost. And in 1919, the winning powers gathered in the Hall of Mirrors at Versailles to decide the punishment. The Treaty of Versailles didn't just take away German territory and shrink its military. It demanded reparations, staggering sums of money to be paid to France, Britain, and their allies for the cost and devastation of the war. The number eventually settled on was around 132 billion gold marks, an amount so large that some economists at the time said it was mathematically impossible for Germany to ever pay it off. Germany's government faced an impossible choice: raise taxes on a population already exhausted by war and lose public support entirely, or print money to cover the gap. They chose to print. It's worth pausing here, because this wasn't a single reckless decision made in a single afternoon. It was a slow accumulation of smaller decisions, each one seeming reasonable in isolation. A little more currency to cover this month's payment, a little more to keep factories running, a little more to prevent unemployment from spiking. Each individual choice looked survivable. It was only when you stacked all of them together, year after year, that the true scale of the problem revealed itself. This is often how financial catastrophes actually happen. Not through one dramatic villain twisting a dial, but through a series of small, defensible choices that quietly compound into disaster. At first, it seemed manageable. A little inflation, a temporary fix while the economy recovered. German officials assumed exports and industrial growth would eventually close the gap. But the printing presses didn't slow down. They sped up. Every time the government needed to pay reparations, cover wages, or fund basic services, it simply ordered more marks into existence. And every new mark diluted the value of every mark already in circulation. By 1921, prices were rising steadily, uncomfortable, but not yet catastrophic. Then in 1923, everything changed. Germany fell behind on reparations payments, and French and Belgian troops marched into the industrial Ruhr Valley to seize coal and goods directly as compensation. German workers in the region responded with mass strikes, refusing to work under occupation. The government, desperate to support the striking workers and keep the economy from collapsing entirely, did the one thing that guaranteed collapse. It printed even more money to pay the strikers' wages. This is where hyperinflation stopped being a policy problem and became a nightmare of everyday life. And this is the part of the story people find hardest to believe, because none of it sounds like ordinary economics anymore. It sounds like science fiction. Picture a father collecting his wages in the morning. A stack of banknotes so thick it needed a suitcase or a wheelbarrow just to carry home. By the time his wife reached the bakery that afternoon, the same stack of bills might buy half of what it could that morning. Shops began changing prices multiple times a day. Waiters would ask customers to pay for a meal the moment it was ordered, not after eating, because by the time dessert arrived, the price would have already gone up. At its absolute peak in late 1923, inflation was rising at roughly 29,500% per month. Numbers stopped making sense to ordinary people. Prices weren't measured in thousands or even millions. They were measured in billions and trillions. A single American dollar was worth over 4 trillion German marks. Banks issued notes with so many zeros printed on them that some businesses simply stamped extra zeros onto old bills rather than print new ones fast enough. And here's the detail that captures just how absurd things became. Banknotes became more useful as something other than money. Families really did wallpaper entire rooms with worthless bills, because wallpaper itself cost more than the currency plastered all over it. Parents gave stacks of banknotes to children to build towers and play with, because the paper had become essentially worthless as money, but still worked fine as a toy. People burned bundles of cash in stoves to stay warm through the winter, because actual firewood had become more expensive than the money meant to buy it. For Germany's middle class, this was devastating in a way that went far beyond inconvenience. Generations of families had built savings accounts, pensions, and life insurance policies meant to protect them in old age. Almost overnight, those savings became worthless. A nest egg that could have bought a house in 1918 couldn't buy a loaf of bread by late 1923. Retired teachers, widowed mothers, and small shopkeepers who had spent decades quietly setting money aside watched an entire lifetime of discipline evaporate in a matter of months, with nothing to show for it but a drawer full of meaningless paper. Meanwhile, people who owed large debts, including some wealthy landowners and industrialists, found their debts effectively erased, since they could pay back loans with currency that had become nearly meaningless. Some of Germany's wealthiest businessmen actually expanded their empires during this period, buying up property and factories, using loans they knew would be worth almost nothing by the time repayment came due. Wealth didn't just shrink, it was violently redistributed, rewarding debtors and speculators while punishing savers and pensioners, destroying trust in banks, currency, and government institutions along the way. By November 1923, the German government finally acted. It introduced a new currency called the Rentenmark, backed not by gold but by mortgages on land and industrial assets, deliberately limited in supply to restore confidence. The old marks were exchanged at a staggering rate, 1 trillion old marks for a single new Rentenmark. It worked. Almost immediately, prices stabilized. The printing presses were reined in. The panic that had gripped the country for most of a year began to fade, but the damage to German society had already been done, and it went far beyond economics. An entire middle class had watched its life savings evaporate, through no fault of its own, and many never fully recovered financially or trusted paper currency again. Some historians argue this single year did more to destroy German faith in democratic institutions than almost any other event of the era, because it taught an entire generation that the value of their money, their labor, and their savings could be erased by decisions made in rooms they had no voice in. Historians have long debated how much this experience shaped the political chaos of the following decade, a population desperate for stability, resentful of the government that failed them, and increasingly open to radical movements promising order at any cost. Just a decade later, that resentment and economic desperation would help fuel the rise of extremism that plunged the world into an even darker chapter. It's a sobering reminder that currency collapse isn't just a financial event. It reshapes what people are willing to believe and who they're willing to follow when the ground beneath them stops feeling solid. Even today, Germany's economic policy is shaped by the ghost of 1923. The country remains famously cautious about inflation, prioritizing price stability above almost everything else, a direct institutional memory of the year money stopped meaning anything. And here's the uncomfortable modern parallel. After the 2020 pandemic, governments around the world printed trillions of dollars in stimulus almost overnight, and inflation surged to levels not seen in decades. Grocery bills rose, rent rose. People who had never thought twice about the price of eggs suddenly found themselves doing quiet math at the checkout line. Nowhere near Weimar levels, nothing close, but enough to remind economists, policymakers, and ordinary families why this century-old story still gets told in economics classrooms around the world. Because the moment a government convinces itself that printing money solves every problem, it's already walking down a road Germany walked in 1923, and once that road starts, it's brutally difficult to turn back. Confidence in a currency isn't something you can rebuild overnight. It takes years to earn and, as Germany discovered, only months to destroy completely. So the next time you hear a headline about a central bank printing more money to solve a crisis, remember the wheelbarrows full of cash, the banknotes wallpapering apartment walls, and the family stacking billions of worthless marks like toy blocks. Because money only has value as long as people believe in it. And once that belief breaks, it can break faster than anyone thinks possible, and take an entire generation's trust down with it. If this story surprised you, imagine what history's other financial collapses looked like from the inside. Subscribe, because we're only getting started.